Now we are going to look at liquidity and solvency ratios. I think liquidity ratios might be my favorite ratios to comment on just because there's so much to say. And as you guys know, I get extremely excited about ratio commentary and analysis because it really helps me to see if you understand exactly what it is that you are doing and you're not just adding and subtracting figures and preparing your financial statements. You're actually really in tune with what it is that you are doing. So we are now going to look at liquidity ratios first. So liquidity ratios are all about, can we meet our current obligations? So in grade 10, I told you guys that, remember, you get liquid and you get something that is solid. So liquid, think of a current is what I told you in grade 10. So a current is forever flowing. So these liquidity things are things that are flowing through your business. It's a current, therefore current assets. So we are only going to focus on everything in the current section of your SFP. So that means your current assets and your current liabilities. So that's your current obligations. So when we are looking at our current assets, we are looking at our inventories, first of all. Secondly, we are looking at our trade and other receivables, and then our cash and cash equivalents. So you need to understand what is happening within those three things for you to understand how this is flowing through the business. If we're looking at inventory, we are buying inventory with the idea of selling it at a profit. Inventory is one of our largest amounts if we're looking at big firms out there. So it's a big cost that you are carrying. With big costs comes big risks. Then if we're looking at our trade and other receivables, think of debtors. Debtors are good because you're getting in more sales. However, once again, it is a big risk because what if you don't get your money? And then if we're looking at cash and cash equivalents, seems like a fairly safe thing because we have money. That's wonderful. However, if I have too much money in my current bank account, I'm earning less interest than the interest that I would have received had I decided on a fixed deposit. Also, what if I'm keeping all of this cash in my petty cash? With that comes the possibility of theft. Okay, then if we're looking at our current liabilities, we're looking at things that we have to pay within the next 12 months. So we're looking at current portion of loan. We're looking at our creditors control. So are we paying our creditors or aren't we? So current ratio, current assets to current liabilities, and we want to get to a ratio of 1,5 to 1 up until 2 to 1. So anything within that range is that we are safe. So we do not want to be below a ratio where we have less than R1.50 in current assets for every R1 in current liabilities. But we also don't want to be in a situation where we are above R2 in current assets for every R1 in current liabilities. So that is looking at your total current assets to total current liabilities. But then we are also going to get to a point where we are going to remove the inventories, because worst case scenario is I can't sell my trading stock. And I don't enjoy going back to this, but it's something that you are familiar with, is COVID. Okay, so in COVID, a lot of businesses couldn't sell their trading stock because they had to close their businesses for quite some time. So yes, they had a lot of inventory, but they couldn't sell it. So are you still liquid? Can you still meet your current obligations without selling your trading stock? And that ratio should be 1 to 1, meaning that if I really cannot sell any of my trading stock, I will still be able to meet my current obligations. Then working capital. So this is what we are going to use to analyze our liquidity. So your working capital consists of your current assets and your current liabilities. So first of all, our inventory. What is your stock turnover rate? Are you selling your stock fast enough? or are you holding on to your stock? Because remember, the more stock that you hold on to, the less cash you have available to use. So the stock turnover rate is your cost of sales divided by your average inventory. In other words, your inventory that you had last year plus your inventory that you're closing with this year divided by 2. And this is going to tell us we have a high stock turnover rate. In other words, we are selling a lot of our stock, or no, we are basically holding on to our stock, or we can't get rid of the stock. So this could be that you maybe are purchasing the wrong inventory. People do not want to buy it, or you are just buying too much all at once, and then it takes long for you to sell that stock, and therefore you don't have a high turnover rate. You do not want to hold on to your stock for too long, but I'm going to still discuss that. So that goes together with stock holding period. In other words, I now have this turnover rate where I, let's say, have to replenish my stock 10 times a year. And what does that mean? Does it mean that I'm holding on to my stock for 20 days, for 40 days? How long am I holding on to this? And this is also going to be important when you're looking at what is this partnership doing? Are we selling non-perishable goods, or are we selling, for instance, fresh goods? Like, is it the bakery? Is it a place like Kauai, for instance, where you have fresh foods that you are working with? Then I definitely don't want to hold on to my stock for 30 days, because that avo is not going to look good after 30 days. And for the stock holding period, do not get confused. Luckily, you do have your formula sheet with you should you just get a bit confused. So the stock turnover rate is not in days. That is how many times. Your stock holding period is how many days am I holding on to my stock. And that's why you have the times 365. And this is the one where your average cost of sales is above. So you are taking your average cost of sales and you are dividing that, not, my gosh, not the average cost of sales, the average inventory, typo, inventory, there we go. Average inventory divided by cost of sales. Whereas your stock turnover rate, you had your cost of sales divided by your average inventory. Okay, so just don't get confused there. Your stock holding period answer must be given in days. So how many days am I holding on to this? Obviously, you don't want to hold on to it too long, because stock can go obsolete. There's a risk of theft here if it's just laying there somewhere in a storage room. And then it also means that too much cash is tied up in your trading stock. So if you're looking at that current ratio versus asset test ratio, and you then remove your stock, if that asset test ratio is extremely lower than your current ratio, it means that you are carrying too much stock. You have the risk of stock going obsolete, and also you have too much cash tied up in stock. What if I cannot sell my stock? What's going to happen to my business? And then you'll see there that it says usually 30 days, but it is definitely highly dependent on the industry that you are operating in. Then we also have our debtors collection period. We will tell you what the credit policy states, but usually it is we want our debtors to pay us within 30 days, because we need that money in order to buy new stock, in order to pay our operating costs. And then we are going to look at the average debtors over only credit sales. Okay, so not total sales, credit sales. And once again, this is given in days, and you definitely want to be within 30 days. But if you move over 60 days, you are not managing your debtors efficiently. And then you will most probably have bad debts. Then with our creditors, we also want to pay our creditors within the credit terms given by the creditor, which is usually between 30 and 60 days. And here again, we are only going to look at the credit side. So it's your average creditors divided by only your credit purchases. If we don't specifically tell you what the credit purchases is, then obviously you can work with your cost of sales, because then it means that all of your purchases are on credit. But we usually tell you the percentage or the exact amount for your credit purchases. And then, why is this important? Because if you don't stick to your credit terms of 30 to 60 days, then this relationship is going to go sour. It's going to get to the point where your creditor is going to charge interest on your account, which means that now you have more expenses. It could be that they won't give you trade discounts, so you are also then increasing your costs there, so your cost of sales will be more. Or it could just be that they won't allow you to buy on credit anymore. That means that you need more cash to be able to replenish your stock, and then you might get into a situation where you have some cash flow issues. Then your solvency ratio. So this measures if you will be able to sell. If you sell all of your assets, will you then be able to pay all of your liabilities? So worst case scenario, you are in financial problems here, you're experiencing financial problems, you need to solve all of your problems by paying all of your debts. So will I be able to do that using all of my assets? So it's just looking at total assets versus total liabilities. And the norm here is 1-to-1. You just want to be able to break even and walk away from this without owing anyone anything. So you don't want to go below 1-to-1. You want at least R1 in total assets for every R1 in total liability. So that means fixed assets, financial assets, or non-current assets, plus your current assets to your non-current liabilities and current liabilities, so all added together. And that is, in a nutshell, your current ratios, and then your solvency ratio. So current ratios and asset test ratio going to your liquidity, and then your solvency ratio when you're looking at the bigger picture, the total assets and the total liabilities.